Today we're focusing on the fact that gold and silver are both surging, but why is it that Bitcoin just isn't going up? With over 4 million coins being hoarded, can Ethereum still break through 4,000? Its internal closed-loop system has been exposed. Why is it trying to separate itself from Bitcoin mining? Tuesday, December 23rd, this is the BitcoinTV Chinese channel, and I'm Michael greeting you from Singapore. Let's take a look at the must-watch data headlines from the crypto world over the past 24 hours. Today's market is still consolidating after a pullback from recent highs, and overall, there's not much momentum. In the past 3 months, we've seen gold break through 4,400 and silver surge to 69, but Bitcoin is still stuck in this awkward position, fluctuating around 88,000. The market just isn't showing much strength. Why is that? When geopolitical tensions are high, policies are swinging back and forth, and there's an expectation of lower interest rates. Money tends to flow into more stable assets first. Gold is the first to benefit, while silver, its supply is relatively tight, and it's more heavily speculated on, but its gains haven't really expanded. And what about Bitcoin? It's considered the riskiest asset, so when capital seeks safety, it's naturally the last option on the list. If we look at on-chain data, things become even clearer. Demand has now turned negative, and the short-term players' SOPR has been below 1 for a long time, indicating that many people are selling at a loss and withdrawing at the same time. In this situation, any rebound is especially likely to be quickly suppressed. It's no wonder things aren't going well. Now, looking at the current prices of Bitcoin and Ethereum, they're still relatively stable. Bitcoin is fluctuating around $88,000, and Ethereum is consolidating back and forth above $3,000. Overall, the market doesn't look like it's collapsing, but the trading activity on exchanges is clearly cooling down. On November 24th, when Bitcoin was at $88,438, the 7-day cumulative inflow to Coinbase and Binance was still $21.026 billion. And $15.279 billion. At that time, everyone was busy rebalancing their portfolios. They were preparing to hedge and sell. But by December 21st, when Bitcoin had risen slightly to 88,600, Coinbase's inflow had dropped directly to $7.77 billion, a decrease of 63%, and Binance also fell to $10.259 billion. To sum it up in one sentence, the price range is about the same, but the capital is clearly more cautious. Right now, there's obviously not enough liquidity to push higher. To put it even more simply, this round is basically the market slowing down and hitting the brakes starting from early October. Bitcoin has already pulled back by 36%, and more than 40% of the open contracts have been liquidated. High-leverage speculative positions have basically all been wiped out in this round. December was even more intense, with stablecoins starting to leave exchanges on a large scale. Ethereum ERC20 stablecoins saw the biggest drop in reserves this cycle, which shows that people are in no rush to make moves. The data from Binance is especially telling. At the beginning of October, stablecoin reserves increased by $8.9 billion within 30 days. But once the trend shifted, $1.9 billion has already been withdrawn. The money has either gone into cold wallets for safekeeping, or it's been put into DeFi to passively earn yields. In any case, no one's in a hurry to rush in anymore. As long as new liquidity doesn't return, the market will most likely remain in a low-activity, defensive state. Alright, please like and turn on the notification bell. We're here to help you sort through news in the Web3 world, closest to making money. From Monday to Friday, as a member, a basic wealth code awaits you daily, letting you experience the excitement of trading during a bull market. Today, let's take a look at Ethereum. Why? Because yesterday, we said that there won't be another altcoin season, and a lot of people got upset. The altcoin supporters all said we need to be responsible with our words. Of course, let's review the previous logic. Bitcoin rises, which drives Ethereum up, and that's what brings about an altcoin season. So now, the reason we're focusing on Ethereum is to see whether altcoins will still rise along with Ethereum, and whether there's still hope for Ethereum. As you all know, after the Ethereum ETF was approved, 2 companies bought Ethereum from $2,000 all the way up to over $4,000, right? Bitwise kept buying and became one of the top institutional holders of Ethereum globally. Their goal is to acquire 5% of the global circulating supply of Ethereum. So, what exactly is it about Ethereum that attracts institutions? It's not just that Ethereum itself can appreciate in value, but it also offers staking rewards, because Ethereum has switched to POS, right? So the signals from institutions are especially clear. They're not just speculating for short-term gains, but are treating Ethereum as the foundation for the future of finance. So do you think Ethereum has a future?
Bitmont recently disclosed that it has added another 98,852 ETH to its holdings. This brings its total Ethereum holdings to over 4 million, reaching 4,066,062 ETH. Based on the current circulating supply of about 120.7 million ETH, its share has now risen to approximately 3.37%. This narrows the gap to its long-term target of 5%.
I expect it to move to 5,500. I like Ethereum a lot. It's my favorite among the cryptocurrencies. Some of these have a slightly smaller market cap compared to some of the large caps. So I think Reddit is phenomenal.
According to the announcement, the company's asset portfolio is about $13.2 billion. Besides Ethereum, it holds 193 bitcoins, $1 billion in cash, and has invested $32 million in equity in ETC holdings. Tom Lee, founder and head of research at Fundstrat Global Advisors, pointed out that BitMine managed to increase its ETH holdings from 0 to 4 million in just 5.5 months, and plans to launch enterprise-level staking services in early 2026. This will further strengthen institutional participation.
Ever since he started hoarding Ethereum, he's only been doing two things. On one hand, frantically buying coins, and on the other, as CEO, constantly building a persona for Ethereum. What kind of persona? The institutional version of digital bonds. He's been lobbying listed companies everywhere to hoard Ethereum with him because Ethereum also offers staking yields of about 4% to 5% annually, right? So Ethereum not only allows companies to gain value appreciation, but also provides a stable annual yield. This is the main reason why companies are confident in hoarding it. But what I want to tell everyone is that actually, Bitcoin also offers returns from holding coins, and there are also financial products for earning yields. Our Buying is a staking and wealth management channel provided for our members and a broad base of fans. Our Bitcoin-denominated yield for the 3-month term has already reached an annualized rate between 7% and 8%. Now we are opening a new 1-year Bitcoin-denominated wealth management product. You can participate with just 0.1 Bitcoin. Our goal is to achieve an annualized yield of around 10%. This return can easily outperform all institutions. If you disagree, feel free to challenge us. Participating is very simple. Just scan the QR code on the screen, contact customer service to join the group, and you can learn how to invest and win with Bitcoin mining. The reason why Bitcoin hash rate can rise so high is that the hash rate has already reached its ceiling. Because all the major companies have seen the future potential of Bitcoin, and they all want to lower their coin holding costs through mining. Tiger is no exception. Its influence in the mining industry comes from a company called Northern Data. Originally, they wanted to get a piece of the action in Bitcoin mining, but now most people in the Bitcoin mining industry know that miners' profits are getting lower and lower, right? If there's another halving in 3 years, almost all mining machines will be phased out. So Northern Data has already started shifting to the AI sector. Originally, they built a technological landscape, aiming to have a stake in both computing power and B. But what happened? By the end of the year, internal transactions involving peak mining came to light, directly dragging Tether into discussions about related party transactions and regulatory scrutiny. This area, which was originally a low-key strategic layout, is now visible to everyone.
The publicly listed company Northern Data, controlled by Tether, sold its Bitcoin mining division, Peak Mining, for $200 million, but the buyer was not an external third party. Instead, the entity is controlled by Tether's CEO and CFO through multiple layers of affiliated companies. Although the related mining assets have been removed from the public company's financial statements, actual control still remains in the hands of Tether's core leadership personally. At the same time, Tether had previously provided large loans to Northern Data and established a business partnership with Rumble, gradually building an internal circular ecosystem centered around USDT cash flow.
On the surface, this news seems to show that TED has spun off the Bitcoin mining operations controlled by Northern Data, but in reality, it's just moving assets from one hand to the other, still within their own circle. The underlying issue revealed here is, why does Tether want to spin off the Bitcoin mining business, yet still keep it under their own control? On the surface, the company appears to have let go, but why divest from Bitcoin mining power? This is a question worth pondering. In 24 hours, there's been an 11% drop. Will the battle for control over Aave's brand assets trigger even greater selling pressure? With regulatory, AI, and RWA undergoing triple transformations, can the crypto world really move away from speculation and return to real value by 2025? Recently, even in the bear market, the DeFi space has been catching attention from gossip. Everyone is watching Uniswap, the top dog, demanding, "How are you spending our money? You need to explain the accounts clearly." As for the second in command, they're constantly arguing over executive salaries. So what happened? It seems like only Aave has been relatively quiet, and there's no drama like Aave Lab's phone incident involving someone named Ernesto Boado. He raised a question about who actually has the final say over brand assets at Aave. Originally, this was something that should have been discussed internally, with everyone sitting down together to talk it over slowly. But instead, the issue was brought to the community, and the community directly voted to settle it. So once again, Aave's governance process and the boundaries of its authority have come under the microscope.
A dispute over who controls the brand and online presence of Aave, a decentralized lending platform, has spilled into governance and procedures, causing the Aave token to drop sharply, down 11% in the past 24 hours.
The key issue in this dispute isn't the content of the proposal itself, but rather the pace at which it was advanced and whether the process complied with regulations. Aave founder Stani Kulechov, citing high community interest, directly announced that the proposal would be put to a vote, but did not obtain the consent of the proposal's initiator, former Aave Labs CTO Ernesto Boado. Boado later publicly stated that he was neither informed nor authorized the vote recommendation, and argued that forcing a vote while discussions were still ongoing undermined the community's trust principles. Mark Zeller, head of the Aave-chan initiative, commented that the proposal was pushed forward unilaterally and that the vote was scheduled during a holiday, which severely affected participation. Although Kulechov emphasized that the discussion had lasted several days and that the process was in order. However, this explanation clearly failed to quell the community's dissatisfaction.
What is Aave? Aave is a decentralized lending protocol where you can use your stablecoins as collateral to borrow another type of token, or you can provide loans on the platform to earn interest. Both are possible. Aave is so large that every move it makes is seen as a model for others. So even though this incident didn't involve any loss of funds, it did expose the issue of decentralization. When it really matters, everyone steps in to take control together. But there are always people who, at critical proposals and key moments, want to jump the gun and get ahead of everyone else. Everyone knows that no matter how much external regulators question your transparency or compliance, it doesn't really matter. But if problems arise internally, that's a fatal issue. Things like disputes over who owns domain accounts. These are all signs of internal division. So this proposal serves as a wake-up call for everyone. If, in a decentralized protocol, you don't clarify the rules and ensure equal participation rights, then decentralization might just be an empty slogan. Coinbase has released its outlook for the crypto market for 2026 and next year. To sum it up in one sentence, people can tell fewer stories and be more pragmatic. Their views on Bitcoin, Ethereum, regulation, and technology are fairly neutral, not overly optimistic, but not pessimistic either, reflecting a calm and rational perspective. The core message is very clear. If the crypto market wants to break into mainstream finance next year, it needs to refine its products and make them solid. Just relying on storytelling and hype is no longer enough. Those days are over. He also made predictions about the US macroeconomy, believing that the US economy won't go down that easily. At least it should hold up just fine through 2026. So the first half of 2026 will be more like the slow and steady pace of 1996, rather than the all-night party of 1999. So, is next year really going to be a major bull market? That's still a question mark. That's why Coinbase says, right now, what we need to focus on isn't just slogans, but whether the crypto space actually has technologies that truly solve real-world problems.
With regulatory breakthroughs expected in 2025 and the launch of spot EDF and DAT, the global crypto regulatory framework will become even clearer in 2026, providing a much thicker safety cushion for institutional capital to enter the market. DAT will also be upgraded to 2.0, no longer just a tool for holding coins, but will focus on transactions and storage around block space, competing for the status of hard currency in the digital economy.
I'll go out on a limb and say Bitcoin at 180,000 either December 23rd or December 31st, 2026.
Increased interface participation drives privacy demand. ZKP and FHE technologies will accelerate implementation. AI crypto integration, application-specific chain expansion, and RWA financing advantages, especially tokenized equity, are reshaping industry infrastructure and the sector's competitive landscape.
So, what does Coinbase mean? It's very clear where the next big trend will be next year. Actually, there are quite a few things that exchanges can do, but the gambling aspect that used to be prevalent will decrease. Derivatives, which everyone used to see as just leverage, may now truly become integrated into mainstream finance and even into decentralized spaces. Prediction markets are a field that everyone has to pay attention to. Changes in tax policy may lead to an expansion of this market, and whoever can build the best entry point for predictions will be the first to benefit. Stablecoins are the essential anchor for the whole system, but in reality, stablecoins don't have much to do with retail investors. If it really becomes usable, it's the institutions that will make the money. So looking ahead to 2026, the reality is, don't let your product be half-baked. Make sure it's compliant and doesn't step on any landmines, and don't let innovation turn into a game of musical chairs for a select few. As long as you avoid these pitfalls, which of the trending opportunities do you think can be seized? Tell me in the comments. Let's check out the latest updates together.
Profit founder Zhao Changping has officially announced that BNB has been integrated. Now you can use BNB for top-ups, giving BNB yet another real-world use case. BNB is no longer just something you hold and watch. Ali Yahya from a 16Z Abdul Qadir summed up the essence in one sentence. From now on, the crypto world won't be about who shouts the loudest or tells the biggest stories, but about who can truly deliver on privacy, withstand regulation, attract users, and give institutions the confidence to enter. Privacy is the strongest moat in the next cycle. Zoo strategy was singled out by Nasdaq for not meeting the stock price standard. The price has already fallen below $1, crossing the line. If it cannot get back above $1 for 10 consecutive trading days before June 15, 2026, it will not just be a warning, it will directly face delisting and be moved to over-the-counter trading. The real test is simple. ByteDance is ready to invest real money, $23 billion, directly into AI. No empty promises, no fluff. They are determined to make artificial intelligence the core of their next phase, the main battlefield. He originally appealed hoping for a lighter sentence, but the more he appealed, the harsher the verdict became. It was proven that the Korean man used cryptocurrency to help a voice phishing gang launder $68,000. Not only did the court refuse to show any leniency, it actually increased his punishment. Truly a textbook case of an appeal backfiring.
You have to understand, in the crypto market, the most expensive cost is never the transaction fees, spreads, or taxes. It's your emotions that cost the most. When the market is bullish, you get FOMO and buy at the top. When there's panic, you sell at a loss. When there's a rebound, you want to add to your position. These seemingly different actions all stem from the same mistake, handing over your decision-making power to your emotions instead of to a system or discipline. The moment you find yourself feeling excited, anxious, angry, or resentful while staring at the candlestick charts, that's when the market has already taken you by the nose and is leading you around. This is the worst time to place orders or make trading decisions. Truly mature traders never rely on their feelings to enter or exit trades. Instead, they execute pre-established plans mechanically, only when their emotions are most stable and their logic is clearest. Use rules to counter human nature and use probability to counter impulsiveness. So please remember, once trading emotions come into play, it's time for your account to exit. If you understand, give us a like. All right, that's all for today's program. Here are all our membership benefits. We hope you can join our membership so we can all become wealthier together, little by little. See you tomorrow.